which kills demand. Meanwhile, if the 10-year stays elevated, real rates stay punitive for gold and silver. Risk is getting squeezed from both sides.
But Melissa, the euro is holding at 1.17, not collapsing. What's your read on whether the dollar strength is actually structural, or are we just seeing positioning ahead of data?
Fair point. The positioning matters. But inflation expectations are what anchor this. If 10-year yields stay where they are, central banks stay hawkish, and the dollar stays bid. That's the mechanical link. Commodities can't catch a bid in that environment.
So you're saying 10-year sets the floor for dollar strength, not the ceiling. That's different from saying they are in opposition. One leads, the other follows.
You're right. The 10-year leads. The dollar follows its signal. And that signal right now is telling risk assets to wait. We tested this method on 212 Bitcoin trades it never saw. Intraday, the system hit 57% of the time across 1,000 bars. Swing trades collapsed to 3%. The rule works when volatility is hourly. It fails completely when you stretch the horizon.
Peter, here those intraday wins generated 32.5 risk units total, but you're glossing over the sample. How many of those 179 Bitcoin intraday trades closed flat?
33. That's real slippage, not noise. In live conditions, we're hitting 57% and pulling 1.5 risk per trade. On Bitcoin, swing the backtest shows minus 86 cents per trade. We don't use it there anymore.
But your current live desk is only 23 graded trades. That's not enough to know if the intraday edge is real or just luck bleeding away.
Agreed. Which is why we trade it small, Peter. The method survives where it tested. Everywhere else we stop. Bitcoin's largest single print this session was $137,000 on the buy side at $76,069, absorbed into the market without moving price. That's 46 times the median trade size. What matters is the cumulative delta buyers have put in 3.7 million against 1.8 million in sales. That's a 55% edge, and it's held through the entire session.
Melissa, absorbed doesn't mean passive. That large buy came in 165 seconds ago. The question is whether we are seeing accumulation or a trap, because you've got 3,100 trades generating that delta, which means the median is still just $76. Are the big prints at the top of the book or buried deeper?
They're sitting. The three largest buys, the 137, the 120, and the 107, all within $4 of each other at price. That's not random. Institutional money doesn't print that way unless it's running. Peter, this flow pattern matches the setup we saw before the March rally.
Before you go there, the cumulative volume distribution shows we've still got selling pressure concentrated between 76,000 and 76,050. Those blocks haven't cleared. One absorbed print doesn't break a down day.
True. but the largest seller only moved 41,000. The buyers are outgunning them 2-1.
Ethereum long in swing timeframe, entry 2346, stop at 2156.5, targeting 2782 for first target and 3066 for second. That's 8.1% risk for 18.6% reward, a 2.3 to 1 setup. The trend is up with the averages stacked and price holding above both the 21 and 200-day moving averages. Closes through the stop, the idea breaks.
You're intraday short in Ethereum at 2415.3, though that's only 0.5% of risk for 1.2% of reward. Why take the trade at all when the swing long you just outlined is already positioned above the 200-day at 1907.7?
Peter, because intraday and swing operate on different timeframes entirely. The short trades the immediate rejection at the 21 period. The swing trade builds the larger trend position. They are not competing, they are layered. Intraday scalps the noise, swing captures the move.
Fair distinction, but your backtests on Bitcoin intraday show only 21% hit rate across 124 trades. How confident are you in either setup when the sample points that direction?
The expectancy is what matters, not hit rate. Both Ethereum and Bitcoin are holding structural support. The risk-reward compensates for frequency. If the averages break, we exit. That's the discipline.
This is a breaking market alert. Bitcoin's largest print this session, $528,000 at 76,152. A 99 lot on the sell side. It hit the market just over a minute ago and was not absorbed. All three major indices closed flat today, but that masks what's really happening underneath. Gold holding just above 4,600, and energy telling us the market's worried about growth. West Texas crude at 86.50, Brent at 92. When oil softens while equities sit still, you're looking at inflation expectations cooling faster than the Fed might like.
Melissa, those energy prices haven't moved all session either. Everything you've quoted is yesterday's close. But you're right to worry about the disconnect if growth fears are real. Why isn't copper down more? It's still at 14,190. What's your read on whether that's conviction or just illiquidity before the open?
Peter, copper's holding because China hasn't panicked yet. Once they do, that's your real inflation signal breaking. The metals complex needs to separate gold up on safe haven, copper down on recession. Right now they're moving together, which tells me we're still in a wait-and-see on rates. That's the story equity traders should care about.
Fair point on the correlation. But the euro sitting flat at 1.1676 against all this suggests the ECB's already priced in softer growth. Shouldn't that be moving copper more aggressively downward?
Only if we believe the euro's right. I don't yet. Bitcoin's 21-day moving average sits at 76,428, but price is trading below that at 76,131. The 200 is at 76,253, so we're sandwiched between the two key levels. RSI is soft at 38, and the Trend Strength Index is strong at 49.6, which tells you the downtrend has conviction even though we're oversold. That matters for inflation expectations, because commodity weakness usually precedes rate cuts.
Melissa, the structure tells a different story than the moving averages. You've got higher highs and higher lows on the candle chart, which contradicts the downtrend label. The MACD histogram is negative at -6.3, but it's rising, so momentum is turning. Are you reading this as a corrective bounce within a larger down move, or do you see a reversal setup forming?
Peter, the stacking is real. The 9, 21, and 50 are all compressed above price. That's bearish structure. Higher highs and lows happen in downtrends too. Support is at 76,027. Break that, and you're headed for 75,562. The inflation play here is that commodities rolling over suggests terminal rate holds, not cuts.
Fair point on the stacking, but the volume-weighted average price is at $76,939. That's $108 above current price. That's mechanical resistance traders will respect. Bollinger Bands show 2% width, which is tight. Volume confirms nothing, so any move off these levels will have thin conviction behind it.
Then you're watching for a break and hold above the volume, weighted average price, to signal real reversal conviction. If that doesn't happen this week, lower lows take priority, and we're testing 75,100. This is a breaking market alert. Bitcoin just absorbed a $319,000 buy print at $75,980. That's 71 times the median trade size. It hit the market 2 minutes 40 seconds ago and got taken cleanly. Ethereum and Solana are showing dangerous long crowding, 64% and 71% respectively. XRP is the most extreme at nearly 74% longs. Retail is chasing momentum, while institutional positioning stayed measured on Bitcoin at just over 51%. When positioning gets this lopsided, inflation hedges unwind fast.
But Peter, the skew on XRP is almost 24 points. That's a liquidity cliff waiting to happen. How much of that long positioning is actually leveraged versus spot holdings?
Most retail flows are margin dependent, which means any correction triggers cascading stops. The real risk isn't the price move, it's the velocity of unwinding through thin order books.
That's the mechanical point. XRP longs need a 12% reversal to hit typical stop clusters. Ethereum needs 14. Bitcoin at 51%. It's balanced enough to absorb selling pressure without panic liquidations.
True, but crowding isn't about price tolerance, it's about what happens when rates stay higher for longer. Leverage gets expensive. That's when positioning matters most.
Crypto finished the week in broad retreat. Bitcoin down 1.8% to just under 76,000. Ethereum off 2% at 2386. But the real damage is in the altcoins. Cardano and Polkadot both down nearly 6%. XRP worse still, down 6.1%. The pattern tells you something about risk appetite right now.
The volume story contradicts that narrative though, Melissa. Dogecoin turned over $3.7 billion in the last 24 hours on a coin that's barely moving. That's not capitulation. That's rotation into liquidity.
You're describing the mechanics, Peter, but you're missing the macro signal. When altcoins underperform this badly against Bitcoin, it means traders are moving backward towards safety. That's what happens when rate expectations tighten.
Fair point on the rotation, but Chainlink's turnover sits at 88 million against Solana's 860 million. Size matters here. You can't treat them as one asset class.
Then watch Chainlink tomorrow. 24-hour range was 11 to 12. Break below 11 means the institutional exodus is real. This is a breaking market alert. Bitcoin just printed $144,000 on the sell side at 76,009.7. That's nearly 60 times the median trade size. The print went unabsorbed, still sitting in the order book 2 minutes and 27 seconds after it hit. Last calls were mixed. Ethereum took 0.56 R on the long. Bitcoin lost 0.67 R on the long, both intraday. 2 flats on the euro and the yen. But the short on Bitcoin hit target for 2.3 R in just over 3 hours. Across 24 graded trades, we're at 59% hit rate, with 0.743 expectancy. That's profitable, Peter. But it means we need discipline on position sizing, because hit rate alone kills you.
0.743 on that sample works if the losses stay small. But look at the backtest on Bitcoin swing trades across 42 rounds, 2.7% hit rate, and minus 0.807 expectancy. Why are we running swing signals on Bitcoin when the mechanics are so broken there?
Because intraday Bitcoin behaves differently. The same system on Bitcoin/USD intraday across 179 trades gives us 0.183. The time frame matters more than the asset. Swing trades assume patience. Intraday assumes liquidity and volatility. We actually have.
Fair. But Melissa, those two open longs in crypto, Ethereum, and Bitcoin swing trades both at 2.3 reward to risk. The market's already crowded in both. Are you confident in those entries or managing risk if we get a fast reversal?
Entries are clean. Stops are tight. Bitcoin stops at 75,166. Ethereum at 2,156.5. If price closes through either one, both ideas are wrong and we move on. That's how we stay profitable through noise. This is a breaking market alert. Bitcoin just printed $136,000 buy at 76,182, about 43 seconds ago. The print was not absorbed. That's 25 times the median trade size.
Ripple's tape is pinned to the buy-side order flow running 100% long, but 74% of accounts are already positioned that way, which means the fuel to push higher from 145 to 152 is already spent before it starts.
That crowding number matters, Melissa, but open interest climbed 0.5%, so these aren't old longs rotating their fresh money, arriving into an already saturated long structure, which changes the mechanics considerably.
Fresh money doesn't change saturation, Peter, it adds to it. 3 minutes left on the clock and invalidation sits at 141, so the tape either holds the bid or it breaks hard.
Ethereum, meanwhile, is showing 87% sell-side order flow with 20 minutes to run, but your long crowding warning last segment 64% hasn't washed out yet, so where's the actual capitulation?
It hasn't come because sellers haven't forced it. When order flow that heavy meets resistance and doesn't flush the longs, the market's testing whether the selling is real. US cash markets are closed, so we're working futures. The S&P 500 and the Nasdaq both flat at their last close. West Texas crude sitting at $86.35, Brent at $92.40. Gold holding above 4,600. The real story here is what's priced in for rate expectations come Monday. Oil especially sensitive to Fed speak.
Melissa, those index futures haven't traded since cash close, so we're looking at stale levels. The energy complex, the West Texas crude and Brent both holding overnight. Are you reading that as confidence the Fed stays patient, or just positioning ahead of data?
Positioning, Peter. There's no conviction in this hold. Real test comes when Asian markets open and we see if copper still at 14,190 breaks down further. That's your inflation thermometer.
Copper's been range-bound for weeks. What would actually break it out of 14,000 in either direction, given where rates are priced?
A hard data miss on employment or a surprise on the inflation print. Copper doesn't move on hope, it moves on growth. That's the trade.
This is a breaking market alert. A $362,000 Bitcoin print just hit the sell side at 76,198. That's nearly 100 times the typical trade size. The block was absorbed. Zcash has jumped 48% to over $800, marking its highest level since 2016 as Grayscale pushes a spot ETF. This matters because it signals institutional appetite for privacy coins, which tightens the correlation between crypto liquidity events and broader risk-on positioning in fixed income.
But Melissa, that 800 print doesn't mean the asset found real demand. Grayscale's product launch can create artificial momentum before the actual buying pressure materializes. Have you seen the underlying order book depth at those levels?
Fair point, Peter. That's why the Washington regulatory push is the real story underneath. Trump's calling for a fair version of the Clarity Act, and the SEC is moving on frameworks simultaneously. Clarity on custody and classification removes the liquidity premium speculators are paying right now.
Agreed, the regulatory bid matters, but it cuts both ways. Once rules land, the pump evaporates. Are we pricing in a 40 to 50% pullback once the act actually passes?
That's precisely what sits beneath the tape. We're trading anticipation, not reality. When rates stay where they are, that risk premium compresses fast.
called 6 winners and 12 losers across 20 graded positions this week, hitting 33%. Ethereum cost us the most damage. We called it up 3 times, and it fell nearly a full % each time. That's the inflation trade turning toxic as rate expectations shift.
But Melissa, your 2 live positions right now have completely opposite order flow readings. Solil is 61% sell side, yet you're calling a breakdown. Why lean bearish when the invalidation at 93.7 is so tight?
Because order flow doesn't lie when it's that extreme. 71% of accounts are still long. That's the flush waiting to happen. We've seen it 6 times in the last month with cryptos tied to leverage cycles.
The BNB call up to 699 runs counter to your thesis though. 65% buy side there, but that's actually lower conviction than Solil's sell picture. You're risking more positions on weaker signal. Which one gets your confidence?
The Solil trade. Ethereum taught us this week that order flow extremes resolve faster than balance tape. We take the pain on BNB if it runs, but the 1% 2% range on Solil works in our favor. That's where the leverage sits. This is a breaking market alert. Bitcoin just absorbed a $190,000 buy print at $76,293, nearly 73 times the median trade size. That trade hit about 2 minutes and 50 seconds ago. The dollar and the 10-year are moving in lockstep this week, and that synchronicity is what matters for everything downstream in commodities. A stronger dollar makes hard assets more expensive for buyers outside the US, which kills demand. The yen sitting at 159 tells you the Fed is still holding rates higher for longer than Tokyo wants. That's deflationary pressure on metals and energy both.
But the euro is holding steady around 1.167, which means the divergence between dollar strength and rate expectations isn't as clean as it looks. Melissa, are you saying the commodity complex is pricing in a weaker demand environment, or are we still seeing inflation hedging underneath?
The hedging bid is still there in gold at 4,600, but it's conditional. It only holds if rates stay elevated. The moment the 10-year breaks lower on recession fears, you get the real move. Copper at 14,190 tells the story better than gold does. Industrial demand is what's vulnerable right now.
That's the mechanical truth, but copper can move on China reopening alone. How much of that current level is actually pricing in demand destruction versus just positioning ahead of stimulus expectations there?
Fair challenge, Peter. Right now it's mixed, but the dollar strength is the weather system everyone's operating under. When that shifts, commodities reprices overnight. Gold is flat at 4,600, holding steady while equities sit motionless. The real story is crypto, breaking away from risk-off logic. Bitcoin and Zcash are in rally mode when they should be following the dollar higher and equity weakness lower. That divergence tells us something about where money is rotating.
But Melissa, that's only true if you're watching intraday moves. On a weekly basis, crypto has tracked the 10-year yield within 2% most months. What's your time frame for calling this a real divergence versus noise?
Peter, we're in a structural shift. When gold holds at current levels and equities are dead flat, but digital assets are climbing, you're seeing hedge demand move into alternative inflation plays. The Fed's messaging on rates is still uncertain, and that uncertainty is backing crypto as a tail hedge.
Fair, but copper and silver are also flat, which weakens your inflation narrative. If real rates were truly destabilizing, we'd see the metals complex moving with conviction. Are you sure the crypto move isn't just technical positioning ahead of options expiry rather than macro conviction?
The metals are flat because demand destruction. The desk is running 56% winners across 25 graded trades. But Peter, that masks a critical split. Intraday Bitcoin, across 179 trades, sits at 34% hits, with positive expectancy. Swing Bitcoin across 55 trades is 2%. The time frame matters enormously for these instruments, and that tells you something about mean reversion versus trend.
The intraday sample has 3 times the trades and the positive expectancy of 0.18, but you're not saying why swing fails so badly on crypto. Is it that swing trades give the trend room to reverse, or is the strategy itself unstable across longer horizons?
Melissa doesn't trade swing crypto the way the backtist ran it. The open book has 2 swing trades active right now: Ethereum long at 2,346, with stop at 2,156, and Bitcoin long at 77,903, with stop at 75,166. Both are positioned above the 200-day. They're trend trades, not mean reversion plays. The difference is entry discipline.
Both those trades are 2.3 to 1 risk-reward, which matches your average across the sample. But you've got an intraday Bitcoin short sitting at 76,252, with a stop at 76,554. That's the same 2.3 ratio on a 40 basis point move. How do you scale conviction the same way on 200 points of risk versus 40?
Position size. The swing trades are smaller. The intraday setup with tighter stops takes a bigger share of capital because the signal is sharper and the noise is lower. That's how you keep expectancy constant across different time frames. This is a breaking market alert. A massive $2.3 million buy block in Bitcoin just traded through at 76,256. That's nearly 47 times the median print size. The sellers absorbed it cleanly a minute and 40 seconds ago.
Gold is holding at $4,604. Silver and copper are both flat. The story here is the dollar. A stronger dollar makes commodities expensive for overseas buyers, and that's a rate story. Markets are pricing in higher rates for longer, which keeps the dollar bid and caps metal upside.
But Peter, what about inflation expectations? If real yields stay elevated, gold should trade higher as a hedge. Are you seeing that dynamic play out in the options market, or is something else anchoring it?
The technicals matter here. Gold broke through key resistance last week, but it hasn't held. That tells you conviction is weak. Until we see a real shift in rate expectations, this stays range-bound.
Range-bound assumes stability, Melissa. West Texas crude is at 86, Brent at 92. That spread tells me geopolitical risk is still elevated. If that tightens, energy inflation could surprise higher and force the Fed's hand.
Fair point, but energy's not showing up in core inflation yet. That's the discipline keeping rates higher for longer. Commodities follow the dollar. The dollar follows rates. Until inflation data breaks the consensus, that chain holds.